Good evening, everyone. My name is Varun Sanan, and a very warm welcome to today's webinar. I hope a lot of you would agree that India as a country is changing, and we are witnessing a big change in the investment landscape as well. With these changing times, some very important and new themes are emerging. As we move from a $4-5 trillion economy to a $10 trillion economy, we'll see a lot of these new themes emerge to reasonable size. Take your mind back to the early 90s when the entire liberalization program was announced. We saw autos emerge as a big theme. Fast forward another 10, 15 years, in the 2000s, we saw IT as a huge theme. And today, IT companies are reasonably sized. They're one of our biggest businesses in the country. We feel that a lot of these new and upcoming businesses will follow the same trend and will grow to reasonable size. We at Edelweiss strive to keep pace with these changing landscape in the investment world and to provide investors some new and very innovative products. If some of you would have tracked our journey as an asset manager, you would have witnessed that we continuously try to innovate and come up with products that will create long-term wealth for investors. In continuation to that tradition, we at Edelweiss Asset Management are proud to launch a bunch of our new exchange-traded funds, or ETFs for short. ETFs are products that are bundled solutions and can be bought and sold by investors as one particular unit or one product. We'll understand more of this. But let me get and introduce two of our speakers for today, our MD and CEO, Radhika Gupta, and our Head of Products and Marketing, Niranjan Avasthi. Hi, Radhika. Hi, Niranjan.
Hi, Varun. Hi, everyone.
So Radhika, let's start with trying to understand the investment case for this first product that we are embarking on, which is the Edelweiss BSE Capital Markets and the Insurance ETF. Radhika, we're seeing, like I mentioned, a lot of change in the landscape in terms of investments. Where do you see capital markets stacking up? What are the growth trends that you're witnessing in the capital markets and the insurance businesses?
Varun, the way I see it is that, and it's great to be talking to everyone, is that as India moves towards its journey, whether you call it 2030, whether you call it Viksit Bharat 2047, as India goes from a 4 to 10 to $20 trillion economy, there are a couple of interesting mega trends at play. And financialization, this meta word called financialization, which includes capital markets insurance, is one of those mega trends. And it's enabled by a few factors. One is that, like China of 20 years ago, today India has a very, very young population, a median age of less than 30, actually, a 1 billion working age population. So these are young people. These are young people who think differently, consume differently, invest differently. They have far more risk appetite than a previous generation that started their investment journey or savings journey. They were predominantly savers, FD investors. This is a more risk-taking, investment-savvy young generation. It's also a generation that has digital access. So today, as a country, of course, smartphone penetration has taken us to a point where 80% of the population is a smartphone user. And they have access to financial products, capital markets products, whether it is doing an SIP in under a minute or opening a low-cost demat account. So digitalization has also enabled people to access capital markets. And the third thing is that we're moving from an aggregate of almost $3,000 per capita income to $5,000 per capita income, when I believe your basic needs of roti, kapda, makan are met in any economy's trajectory, and the real consumption and investment cycle kicks off. So people have money to invest. And if you look at India by the end of the decade, half of us will be an upper middle income or high income country. So I think the combination of a young population with digital access and more money to save and invest is actually going to create tremendous opportunities and buzz in capital markets. And, we're saying will, but in some sense, it's already started. So if you look at some of the that are hitting capital markets. It's actually staggering. I mean, I remember that I had joined this industry in 2017 and we had a 4,000 crore SIP book. Today, month on month it grows. We're sitting at a 25,000 crore SIP book today. At the end of 2010, we had 2 lakh crores of equity assets. 2020, we were above 20 lakh crores. Today, the mutual fund industry is almost 67 lakh crores, and 45 lakh crores of that is equity. So you are already seeing that. A similar trend is happening on the pure. Actually, if you can just go back to the previous one, I just talked about mutual funds because that's my natural bias. But if you look at the number of demat accounts being opened, we have now 1 lakh demat accounts being opened. And of course, as I said, I love capital markets, but insurance is an equally large consumer need today. India is actually the 10th largest insurance market in the world. And whether you look at our need for life insurance or also our need for other forms of insurance, so whether it's in terms of premiums collected, number of policies being issued, or the explosion in the number of life insurance agents, you are seeing actually both the capital market space and insurance space start to take off. And I do believe this is just the beginning.
I would completely agree with you. In fact, Radhika, I had a first-hand experience of this the other day. I was in an Uber and the cab stopped at a red light and the Uber driver was selling a few Reliance shares on the red light. He logged into his app, sold the shares, and within 30 seconds he was done with it and we went on. And that's how fast things are changing and we're evolving. And all of that, like you mentioned, these are daily trends. Like on an everyday basis, about 4,000 crores of insurance premium is collected, or 3,000 trades are executed. These are not small numbers. These are fairly large, meaningful numbers. But moving on, how do you think, a lot of this has changed in the past, and what do you think is going to be the change going forward?
I think one of the natural changes which I opened my conversation with was financialization being a trend. It's happened in the US, it's happened in China. And what is financialization in simple words? It's a shift from physical assets like real estate and gold to more financial assets. And if you look at the table on the left, over the period of the last 10 years, you've actually moved from about 40% financial assets to close to 50% financial assets. Now, we are having this conversation in the context of a product focused on capital markets and insurance. Someone could argue, well, Radhika, financial assets only means banking. It's money going into deposits, etc. In fact, as a mutual fund industry person, one of the headlines that we've been reading a lot over the last year is, oh, bank deposits are not growing because SIPs are taking them away. Well, you see that in the data. If you look at the data at the bottom, actually, deposits as a percentage of financial assets used to be 55%, 54%. That's come down to 24%. What is taking away that space? It's mutual funds, which were actually hard to read. The number is so small, it was hard to read. It was at 4%. It's now 11%. Life insurance is up from 18 to 20%, and others will have direct stocks and everything else. So you're seeing two trends. One is financialization, and second, within financialization, a shift to capital markets. Because as I said, it represents an India that is far more risk-taking.
Completely agree. And these trends will continue to continuously change and emerge and become bigger and better. Do you think that some of these companies, the pace at which they're expanding, will challenge the traditional financial services companies like banks, like NBFCs? Do you think that shift is already happening?
But in some sense, it is already happening. I mean, in one era, banks used to be the only provider of multi-product services. Now you have a whole suite of wealth management companies, by the way, many of whom are listed, that are challenging the hegemony of banks. Banks used to be, FD used to be the primary source of savings and investments. You've got asset management companies challenging that. So you've got asset managers challenging the role of FDs. You've got wealth managers and broking houses challenging the role that banks played in distribution. And of course, I mean, what this slide also shows you is that you've got a very large enabling ecosystem which is all the market infrastructure to make this happen. And while this looks very exciting, one thing I'll point out is even today, you've only got 4 asset management companies listed in an industry of 45. And by the way, I think that 45 will grow. Go back, if you can just go back to that slide, you've got only 6, 7 wealth managers listed, and I am sure many are coming up. And you've not even got all the major market infrastructure institutions listed. So not only do you have an exciting listed space, but I believe that listed space will expand a lot more in terms of the range of players that you will have. So this will be a very rich industry in terms of listed presence.
So, Radhika, can you give us an example in terms of the NSE journey, since that stock's not even listed right now, and we've seen it become a multi-bagger in the private markets. What are your sense about when it hits the public market?
Oh, I don't know if I should comment on this, but NSE is basically the largest. It's the most liquid unlisted stock. I mean, it's effectively a listed company. Now, I remember because we've run, private capital funds also. I remember seeing the journey of, and then this is pre-bonus numbers because I remember those well. I remember seeing NSE at 600, Varun, at a price of 600 in about 2019-20 when we had done it in one of our crossover funds. The last I heard, NSE is trading at 8,000 and it's very difficult to actually get stock in the market. And even today, NSE is valued at 25 times the earnings in the unlisted market. Its listed counterpart, BSE, which has only 20% market share, I think at some has been valued between 70 and 100 times earnings. Now, I'm not saying what's reasonable and what's not, but the point to make is that MCX and BSE are listed, but the largest exchange, which is 70-80% of the volume, is not a listed company yet.
So the landscape of this particular product will probably keep changing and evolving as time goes by, which tells me that it is a long-term wealth creator for investors. In fact, just taking on from what you were mentioning, this chart clearly represents exactly what you were speaking about, that of the 44 asset managers, just about 5 are listed. Of the 1,000 plus stockbroking platforms, only about 23 are listed, and the biggest ones aren't even listed here, and so on. But moving from capital markets, because insurance is also a big part of this product, and you're on the board of an insurance company. Give us some insights on insurance as a business, how that's evolving, and what are the trends there?
I think in insurance, a couple of interesting trends are in place. As your slide says, you're actually currently at number 10, and you are the fastest growing market in the world for the simple reason that just like the asset management industry, penetration in insurance is actually very low. So if you look at insurance penetration in India, it's actually 4%. It's in line with China. It's lower than countries like even Malaysia and Thailand. So that is that. The second is there is a notion called protection gap in insurance, which is essentially what cover people have versus the cover that they need to be financially secure against all the real risks. Now, the protection gap in India is the highest among major emerging economies. So you've got under penetration in insurance, and even those who are insured have a very, very high protection gap. Insurance penetration has to go up. You also, and I see this closely, you also have a regulator and a government that are really pushing an agenda of insurance for all. So, off the record, I can tell you that the insurance regulator actually asks for business plans from individual insurance companies. And it's a regulator that's pushing people saying, expand faster. What are you doing about Har Ghar insurance, insurance for all? So there's actually a much larger social push for insurance for all.
And what about this entire potential of the life insurance industry and the general insurance industry? Because what we've seen is a lot of life insurers getting listed. The trend in the general insurers is not that large yet.
See, I think insurance is an older industry. The largest life insurer is listed. The largest private sector life insurer, which is HDFC Life
Yeah.
or SBI Life, both of them are listed. I think both are nifty companies, if I'm not wrong, and they've had a very strong listed journey. I think the biggest thing benefiting this industry is the regulatory tailwinds. Banks are also very large distributors of life insurance. You've also got a lot of digital players. So Policy Bazaar is a listed company, for instance, that is only increasing the adoption of digital policy insurance. So it's also easier to do this. As far as general insurance is concerned, I think the really exciting space there, Varun, is health. Because post-COVID, I think most households have realized, hey, we don't have enough health insurance. And medical costs in India are rising. Need for health is rising. I mean, in a tier 2, tier 3 city now, people are comfortable paying reasonable health costs and they realize the need for health insurance, combined with the fact that you have, as I said, a regulatory push and things like Ayushman Bharat that are pushing this. So digitization, regulation, and consumer awareness that I need to make that investment on my health. Again, you have a couple of listed players. I suspect between five life and five general, we go down a couple of years, the number of listed players in this space will easily double.
I agree. And clearly, what's also happening is the cost of healthcare is going up.
Yes.
And as cost of healthcare goes up, it will motivate more people to get insured. And that is where probably non-life will really take off. Today, its penetration is just about 1%. By this similar trend, you should see exponential growth in non-life. And that makes this ETF that we are launching a very exciting one for not just today, but also for the future. And if people who know or track insurance business, I think our timing is also pretty accurate because the next quarter is the big quarter for insurance
It is.
companies.
Jan, Feb, March is always the biggest quarter for insurance.
Absolutely. So probably earnings post that would push prices up, but that's just an assumption. Might not happen, might happen. But with that, let me get Niranjan in. Niranjan, good evening. Hi. You've been waiting patiently, but welcome to the call. Uh,
Hi, Varun.
Hi. So we've tied up with the BSE on this one to launch this capital markets and insurance index. Can you explain what this product is all about? Radhika made a very strong investment case, but just to dive into a more in-depth in terms of what the product is, what are the construct, etc., that'll be very helpful.
Sure, Varun. I would like to start with a background on why we created this index. We all know that capital markets are zooming. Insurance market has huge potential as capital market has. But when we looked at our diversified portfolios and also diversified indices, the exposure to both these segment was very, very minimal. If you see Nifty 500 index, the combined exposure to capital market and insurance sector is not more than 4-5%. If you look at most of the diversified mutual funds as well, the combined exposure is limited to around 8 to 9%. But we being into the capital market segment, we know the potential. And likewise, there are many investors and mutual fund distributors and advisors who wanted to give this exposure to their client. And with that thought, we went ahead along with BSE to design this customized index, of course, which is available in public domain now. And what we did is from the BSE 500 universe, we selected two main industries, which is capital market and insurance. And to select this, we actually went down to sub-industry level and selected companies which are AMCs, which are exchange and data platform, which are into distribution on the stockbroking side. And within the insurance, it combines life insurance and general insurance. And not only that, we also took into account the market infrastructure companies like depositories, clearing houses, and other intermediaries. When we combine this, we got the entire universe of almost 22 stocks which made this index. So it is basically, to simplify, BSE 500 is the universe. From that, we select stocks from capital market and insurance industry. All the eligible stocks are ranked based on their free float market cap, and the top 30 stocks make up the index. Now, today, as we speak, there is a limited universe of stocks into this segment, which is around 22, and that is where the index constituents are there. Each of these constituents are capped at 10%. As this slide goes, if you see, the exposure to capital market is roughly around 47%, and insurance is 52%. And within each of these subsectors, if you see, we have companies that are listed in India. There are 4 AMCs listed. There are, 4 life insurance companies listed, 4 general insurance companies listed, and likewise, in stockbroking, exchange, and other intermediaries. And this is how a combined portfolio of 22 stock is created at the index level. But what is important also to know is, as we move forward over the next 2 to 3 years, there will be many interesting ideas which will get listed. And we looked at the data. If you see, there are 44 AMCs, out of which only 4 are listed, which are part of the top 500 companies. Many more in line. Similarly, within insurance, life and general, more than 30-40 companies, a long lineup which will get listed. So this universe will expand and will create many multi-bagger opportunities over the next 3 to 5 years.
In fact, what probably will happen is there will be a fight in terms of companies which are doing well to enter
Yes,
the index, and that is a long-term return potential for clients who wish to participate in this idea. So
absolutely.
Niranjan, all of this looks fantastic on the face of it. What has been the backtested performance of this index? You must have delved into it and seen if this index was running live, what it
Yes,
looked like. So can we see some of that,
sure.
for investors who logged in?
So in the long run, if you see, this index has performed reasonably well. In last 1 year, the returns have been around 52%. 3 years, it's around 13%. Since inception, it has been around 13%. However, when you compare this with BSE 500, the returns are slightly lower. The reason for this is the weightage of almost 52% into insurance. Now, while I'm saying this is an underperformance, this is also a huge opportunity for people to participate, because today we are in a we are in a situation where most sectors have done well, and people are looking for sectors where there is still value, sectors where there can be mean reversion, sectors which can bounce back. Now, let's talk about insurance, which is almost 52% of this index, which has caused this underperformance versus BSE 500. If you see insurance sector closely over the last 2 to 3 years, there have been meaningful regulatory changes. One of the major change has been the tax change, which has got affected from this year, where above 5 lakh, there is no tax incentive, which means retail, insurance company had to get into retail uh, for their, business growth. The second is there were changes into the commission structure, expense ratio structure. Uh, Recently, there were also changes on the surrender value, which client would get if they surrender their insurance policy after 3 years and 5 years. But what is the common thread between all these regulation is IRDA, the regulator for insurance industry, is making the product more viable, more purer for the policy holder. I would want to take you back in years like 2013 to 2000, almost 18, where a similar stream of regulations came into mutual fund industry. And during those period, the growth in the mutual fund industry was flat. While we never had listed stocks in that, during those years, otherwise we would have seen how the mutual fund stocks would have fallen or underperformed. But any such period where there are regulatory changes, where the product is becoming purer and purer, the near-term sensitivity to the stock prices is very high. People are usually more pessimistic in the near term. However, if the product is becoming purer, it is always good for the business. We saw that in mutual fund industry since 2018, 19, and especially after COVID, the way it has grown. A similar growth trajectory is expected for insurance business over the next 3 to 5 years. And if you look into that, I think so, the valuation at which they are trading today, which is, their enterprise value to embedded value or market price to their embedded value, they're probably trading at a very reasonable price. And this gives a very good opportunity for investors to get into insurance sector, and especially in this segment, in this index, which has 52% exposure to insurance. I would like to put the past performance in this way, because usually we have seen products being launched when the performance is very, very good. We have been very conscious to include insurance in this index, and we are ready to, take this to the customer, because we believe the opportunity in this segment, especially insurance, when you combine with capital markets, is extremely fruitful from next 3 to 5 years perspective.
I completely agree, Niranjan. And, on both counts, both from, an investment standpoint now in terms of valuations, this is a very attractive proposition. But also in terms of long-term growth prospects, this is a brilliantly designed product. So I think investors will really, really have a favorable outcome by investing in a product like this. Radhika, let me come back to you. Now, let's just finish this off with something that's more like a home turf question, since you're a CEO of an asset management company. And, a big part of this index, almost 15%, is into asset management. And like you mentioned, more and more asset managers will be getting listed as time goes by.
Yep.
How do you see the asset management industry really changing and becoming more profitable and growing over the next 5-10 years?
So, I'd love to share one stat that keeps me personally very motivated as a CEO, and it's usually not in any of these decks. But India is today a $4 trillion economy. At some point we'll become a $10 trillion economy. The US economy, economy was at this point somewhere in the mid 1980s. And I just looked up a stat that when the US GDP grew from 4 to 10 trillion, which is essentially 2.5 times, what happened to their MF industry? And, I ask most people to guess, and they say, oh, it grew 5 times or it grew 10 times. And the answer is it grew 24 times in that period. Now, I don't know whether our number will be 24 or 15, but it certainly won't be 2. So, as a CEO, I'm incredibly optimistic. Incidentally, actually, when it went from 10 trillion to 20 trillion, it grew 2 times. Even then, the mutual fund industry grew 6 times. So the mutual fund industry almost has exponential growth when you see this kind of GDP growth. And that's what you're going to see. As I said, I don't think anyone thought that we were going to have a 25,000 crore SIP book from 4,000 crores. And I think if you go and project by the end of the decade, you'll have close to a 1 lakh crore SIP book in this industry itself. So that just tells you the potential of what we can do. I also think that today you have 4 listed asset management companies, 45 asset management companies in total. I think you could go to a world where 65, 70 asset management companies exist. 15 to 20 of them are listed companies, because after a certain break-even threshold, AMCs become profitable businesses, and they are almost infinite ROE businesses. It's the reason why everyone seems to be applying for a mutual fund license today. So the market will expand, the number of players will expand, and the number of players who are profitable and meaningful businesses and can be listed will also expand. So there's all of that happening. And by the way, this also creates, if this industry grows, a lot of the infrastructure support institutions, so your CAMs, your K-FinTech, etc., also benefit from this growth. So asset management growth isn't just asset management, it's also the infra players in asset management.
Awesome. Niranjan, one last question to you before we open it up for Q&A. Why is no BSE included in this index?
A good question. So, by regulation and by rules of index provider, they cannot have a stock of their parent or subsidiary or an associate in the index. But that is also an opportunity because in the other index, which is NSE Capital Market, NSE, when it gets listed, won't be part of that index. It will be part of this index, which is maintained by BSE.
Phenomenal. So I think we have an edge of NSE as well on this one. So let's open it up for question and answers. You can type in your questions on the chat box, and I will be picking them up for Radhika and Niranjan. The NFO opened on the 10th. It's open till the 24th. So that's your window to invest during the NFO period, where it's free of cost for all investors. It is a product that we are very bullish on. So with that, let me jump into the questions coming through. So Radhika, the first question that's come through is of the businesses or subsectors that are listed here. Which subsector do you think has the highest growth potential amongst the capital market subsectors?
So this is hard to say. I think I would put it this way. I think financialization in itself is a very, very large mega trend. Capital market side of this index is one that, as Niranjan said, has done well. The insurance side is a bit of a value play, but both of them, in terms of their macro opportunity, their penetration, etc., I think are very, very interesting spaces. They are also a tad bit related spaces, as I said. So if asset management companies do well, it's very likely that trading, clearing, settlement, and all the related companies will do well because they are all interlinked. So I don't pick up subsectors, as I said. The other thing I would say is, because the listed universe in this will expand so much, you could actually have multiple subsectors. The composition of this could also be a little dynamic, which is quite nice.
Niranjan, is this a static index, or it keeps rebalancing on a periodic basis?
So, like all other indices, this is an index which gets reconstituted every 6 months. As I said, the constituents are capped at 30. Today, while we have only 22 constituents, imagine after maybe 2-3 years, there are 50 companies within insurance and capital market. Every company who is doing well, the top 30 will be part of these indices, and they will keep rotating. So it's a index which will be rebalanced, reconstituted every 6 months.
And having said that, there is a 10% cap that you mentioned for each stock.
Yeah.
Now, this is basis the weighted free float market cap. Now,
Yeah.
what happens if the one stock, the free float, actually exceeds the 10% cap in the interim? What happens to that particular stock in the rebalancing or the quarterly rebalancing that you
So
mentioned?
due to price movement, the weightage to a stock may drift about 10%. On rebalancing, it is brought down to 10% and distributed amongst other stocks.
Radhika, a question to you, which has come through, which is that a lot of these ETFs are getting launched by multiple AMCs now.
Yeah.
So, as a asset manager or CEO of an asset management company, how do you decide which one is the product that you would want to take to investors?
I think we try to, and look, multiple asset management companies launch multiple products. I would say a couple of things are important for us. One is that whatever the idea or theme is, it should have some sort of mega trend. It should be able to make money in the long term. I think that's very important. Secondly, I think what Niranjan talked about in terms of index construction, we want to do indices that are responsible. And responsible meaning they are broad-based. I'm not saying they will do well or badly, no one knows that, but they are somewhat broad-based. So, we pay very close attention to the construction of this index. Ideally, we don't want to do an index where three stocks comprise 80% of the index. So, because then you're essentially taking risk in three stocks, right? So we want to do indices that are a little bit broad-based, themes that are well diversified. And of course, we want to do things that are not top of market. I'm humble enough to say that not everyone can catch everything at the bottom of the market. But ideally, if the theme is at 120 PE, it doesn't feel like a very nice thing to do. I think investors have a better odd chances of making money. So interesting new ideas that give people access to trends that will do well in the long term. More indices that are not too concentrated and responsibly constructed, let me say that, and themes that don't come at the top of the cycle.
Niranjan, there are a couple of questions that have come in, which I'll direct to you. The first one is that why is it free during the NFO period, and what are the charges that get put on post the NFO period?
So it's an ETF, it has an expense ratio. Broadly, the expense ratio after the listing of the ETF will be around 30 basis point. There is no additional charge while you are investing during the NFO or after the NFO. The only benefit for many investors to invest during NFO is you can invest via AMC website without going through your broker, and you essentially don't pay any brokerage while buying this or getting into this fund during the NFO period. After that, you can sell it off on the exchange once it is there in your demat account. So there is a slight benefit for people who want to invest during the NFO because they don't pay brokerage. You get at the real-time price at which the portfolio will be created.
Cool. Radhika, I'm going to take one last question before we wrap this up, which is these sectors definitely will grow.
Yeah.
But as they grow and as the size increases, margins will come under pressure.
Mhm.
Additionally, these sectors are subject to a lot of regulations, and that will create a lot of volatility in a product like this. Your thoughts on that?
So on margins, and look, these are questions I answer as the CEO of a business every day. On margins, my point is this, we lived in a time where broking rates in this country were 2%. 2%. Used to pay 2% for broking. And today, I think we pay 5 bips as an institutional house, or 2 bips or 3, some number like that. The strange thing is, however, if you think profitability of that industry, the absolute profit pool has come down, it's not come down. Profitability of brokers is at all-time high. We were in a time in the asset management industry where we had entry loads and no TER caps and no scheme categorization. Today, we have limited number of schemes, no entry loads, and very strict TER rules. Yet mutual fund profitability and the profit pool is at the highest levels it was. So India is a country where, and we tell ourselves this as CEOs all the time, volume growth is the story. You will see volume growth that we can't forecast, and margins may come down or margins may remain stable. So it's a story of volume growth. On regulatory changes, Varun, I would say the same about regulatory changes. If I look at the broking industry, there's almost a circular that comes out every 3 months. If I look at the mutual fund industry, there's a tax or circular that comes out so frequently, and people write obituaries of this industry. I think the industry, the capital markets in India have only become more transparent, more regulated, better governed. And I think they've actually grown because they are more regulated, because consumer trust is very high. And players, honestly, and I say this as a CEO of an asset manager, we have become remarkably nimble at adapting to regulatory changes. You talk to anybody in capital markets who runs the business, we know that regulatory changes are a reality and we adapt to them. So I think the industry in that sense has got a 25-year track record of adapting to regulations, margin and tax, and it's done fairly well in that period.
Absolutely. I think, as regulations come, this short-term volatility is a great opportunity for investors to actually cash on if you see the ETF down 3%, 4% because of some regulation, because the long-term growth trends are intact. Radhika promised last question, and this one's really important. which is what is Edelweiss's track record in launching and managing ETFs? How good are we at that line of business?
So we actually, across our passive funds, run a fairly large passive fund business. I think we run about 80,000 crores of passive fund assets. Of course, we run the country's largest fixed income ETF, and we run that extremely well by the name of Bharat Bond. And now we are embarking to, do our equity ETF business with as much panache, I would say, as much responsibility and as much consumer focus. But we run an 80,000 crore passive fund business today.
Awesome. I think we've taken a lot of your questions. We've also presented a very, very stellar investment case for investors to look and invest in this product. With that, we'll wrap up today's webinar, but the teams on the ground are available. Our offices are available to help you in investing in this product. So we look forward to your support, and thank you very much for logging in today.
Thank you.
Thank you.